Hi there, welcome to Kneppy Invest and welcome to a new series on ETFs. Personally, I don't have any ETFs in my portfolio right now. I prefer to be a stock picker, but always want to be open-minded about the possibility of changing the way I invest. So why not do a little bit of research on some ETFs just to see if I do like what I see. Hence this particular video. The other reason I thought maybe this series could be beneficial is because I like sharing ideas. ETFs also generate ideas, particularly if you look at the holdings of an ETF, and ETFs are becoming more popular. I definitely see the attractiveness of ETFs, but not all ETFs are similar. There's going to be some low quality ETFs and some high quality ETFs. Hence the reason I've decided to start this particular series with VanEck MSCI International Quality ETF. Ticker code on the ASX is QUAL. I just want to see how they define quality, and then I just want to see the makeup of this particular ETF. So what I'll do is quickly go through the fund description, how they define quality. I think is very important here because quality is subjective. High quality is going to be different for each and every investor. For instance, my criteria for high quality would start off with revenue growth. I want to see revenue growing through time. The second thing I'd look for would be margins. I prefer to see high margins, high gross margins. And the third thing I look for would be return on equity. High return on equity, high return on invested capital, that sort of thing. So I want to see how they define high quality. And then I want to see the performance of the ETF. I'm hoping this does provide that. And also the components of the ETF. And then we'll have a look at the chart. And the chart will tell us a fair bit. So we'll do that because this particular ETF has been in existence for over 10 years now. By the way, number of securities 301, management fee 0.4%. I have no idea if that's high or low, probably a little bit higher than, say, the more passive ETFs, which just follow an index, because I do think they'll have to make some calculations to get the makeup of this ETF. Okay, so they're looking for high quality companies. That's the fund description. And they define high quality in the key points here. So high return on equity, earning stability, and low financial leverage. So high return on equity, yes, I sort of do agree with that one. Earning stability is an interesting one. So they're swaying more towards defensive companies. That's what I think of when it comes to earning stability. The earnings of a company or the profit of a company doesn't jump up and down like a yo-yo, like mining companies or cyclical companies. So it seems like they are sort of leaning towards defensive companies with that particular criteria. And low financial leverage. Well, yeah, I actually am attracted to companies that are careful when it comes to debt. I never want to invest into a company that has higher debt than they should have. So low financial leverage, definitely can understand that. So 3 criteria here. I definitely would have high return on equity in one of my criterias, but I do prefer revenue growth. I want to see revenue growing through time, and I do like to see gross profit margins, at least stable, if not growing through time. So a little bit different, my definition of high quality, than VanEck. And the other thing I want to see is any sort of performance. In fact, they go through how they calculate the components or the makeup of this particular ETF. Don't really want to go through that and bore you to death. And here we go, performance. So this ETF has been in existence for 10 years. So we do have an ETF inception, 10-year performance, 5 years. One thing you'll notice is if you look at the last 3 years and 1 year and 6 months, 3 months, you can see a fair bit of variability here. So a little bit more noise in the last 3 years. But once you go to 5 years and definitely 10 years, you're going to see how this particular ETF does perform. And it performs pretty good. Total return over the last 10 years per annum, 15.62%. Over the last 5 years, 16.2%. And since inception, 16.59%. And that's the sort of returns you want to see in your portfolio. So this is, or seems like, an attractive ETF just based off the returns since inception and since the last 10 years and during the last 5 years as well. Now, the next thing I want to look at is just the makeup. The components. They go through, this is really interesting, they go through the NAV and premium discount and best and worst quarter returns. That's interesting. Here we go. By the way, this is not the sort of ETF you want if you want income. Dividend yield 1.27%. And that sort of makes sense because I would not say any high quality companies have a high dividend yield, because high quality companies, one of the things they look at, and one of the things that's very important when it comes to companies, all companies, high or low quality, is capital allocation. What do you do with the money that's coming in the front door? And I would say a lot of high quality companies want to turn that profit, turn that cash flow into future growth. So, for instance, Commonwealth Bank wouldn't do that. They would prefer to give all that money back, all the profit they make, back to the shareholders as dividends. So that's why this sort of ETF should have a low dividend yield, because high quality companies don't give much of their profits back to their shareholders. Country weightings, 78% of the companies are United States. That sort of makes sense. Not a lot of geographical diversification there. Or sectors, that's interesting as well. A little bit more diversification when it comes to sectors, but IT is at the top, 30%, healthcare 16.8%, communication services 13.1%, industrials, financials, not many mining companies in this particular ETF, materials 1.9%. In fact, they don't consider materials, energy, real estate, utilities to be high quality. I agree with that. Okay, now we get to portfolio composition. No, holdings. This is what I want. So this is the holdings, not all 302, but you can download via this little thingy here. But I'm just looking at the biggest companies in this ETF, and no shocks. Meta, Microsoft, Apple, and Nvidia, Alphabet are the biggest 5 holdings. In fact, they combine for about 15, 20, almost 25% of the ETF. Now, the interesting thing about that, personally, is that I already own Meta, Microsoft, Apple, Nvidia, and Alphabet, and I consider all 5 of those companies to be high quality. So that leads to the next question. Why would I buy this ETF? Maybe a little bit more diversification, because I don't own Visa. I would consider Visa to be high quality, and definitely it is a company I want to own in the future. So maybe buying this ETF gives me exposure to some of these companies that I don't have exposure to, like Visa. Although I do own Eli Lilly, I'm not sure I'd want to own United Health. Costco, I have thought about buying Costco in the past. MasterCard, yes. Procter & Gamble, Okay, this is where it comes interesting. So Procter & Gamble, it's not a big weighting, only 1.68%. I'm not sure I would consider Procter & Gamble to be high quality. And the reason behind that is Procter & Gamble, I'm not sure there's going to be enough growth. Let's have a look. Actually, I've already done this, by the way. I've already done this with Johnson & Johnson. So let's just stay with Johnson & Johnson. It's a little bit further down on the list. I did have a look at this just before I started recording. And I was just looking for companies that I would not invest in. And the top one probably would be Johnson & Johnson. And I'll show you why. I just wanted to confirm what I thought about Johnson & Johnson, because you might think a certain way about a company, but your thoughts could be wrong. But I did get confirmation. So Johnson & Johnson, a pretty big company, market cap of $357 billion. But I've always thought of Johnson & Johnson as a non-growth company. And I just wanted to see if the company was growing the revenue. And the answer to that is no. So revenue growth over the last 10 years, CAGR, 1.7%. So virtually no growth. Over the last 5 years, 1.4%. Earnings per share over the last 10 years, 0% growth. This is not a growth company. And I do want to see revenue growing. I do want to see profit growing, that sort of thing. For a company to fit my criteria, my own criteria as a high quality company, and Johnson & Johnson wouldn't fit into that criteria. But that makes sense, because we're all going to have different, criteria for choosing what is a high quality company versus non-high quality company. So a lot of people out there probably would consider this company to be high quality, not me. So that is one of the problems with ETFs, particularly with these thematic ETFs. If you look at the holdings, some of these companies don't fit into your own criteria. A lot of them do, but a lot of them don't. Okay, so that's some of the biggest holdings. I'm just going down a little bit further on the list. And I do actually own some of these companies, by the way. So, for instance, I do own PepsiCo, Adobe. But as we go further down, a few companies I want to own, Texas Instruments, maybe Intuit. Yeah, I can definitely see some companies here I would consider high quality that I don't own. And some companies, no. Some companies I don't know anything about, like Nike. What the hell is Nike? I'm joking. Like Hermes International, no idea. Maybe it's an international company. Okay. Next thing is having a look at the chart. And I did have a look at the daily chart just a minute ago, or before I started recording. It looks pretty good since 2023. It's in a beautiful uptrend. But let's have a look at the weekly chart. Because probably if you do buy this ETF, or maybe any ETFs, you want to own it for the long term. And I'm just using Charlie Munger's rule for buying high quality companies. So if you buy a high quality company at its 200-week moving average, more than likely you're going to significantly beat the market returns. So let's have a look at this particular ETF, the Van Eck high quality, what do they call it? And this is the weekly chart going back to when it formed, or when it was put into circular, whatever they call it. And that was back in 2014. The price at that point was $16. And the 200-week moving average is this bottom red line. And funny enough, two best times to have bought the QUAL ETF, apart from when it started, was during the COVID-19 financial panic, when it did hit the 200-week moving average. And it hit the 200-week moving average on the 14th of June 2022. Perfectly, it bounced off it. So there has been two times in the last 10 years where this particular ETF hit the 200-week moving average. Right now, it's well above that particular moving average. So there definitely could be some downside. So eventually, I think maybe in the next year, 2 years, 5 years, maybe even in 7 or 8 years' time, eventually this ETF will pull back enough that you can buy it at the 200-week moving average. So this is actually a good sign. This chart is a good sign that this is a high-quality ETF. So pretty good returns and a pretty good looking chart. Okay, that's all I really have for this particular video on the QUAL ETF. It's looking really nice. In fact, if I was an ETF investor, this would be probably high on my list. Now, to be honest with you, I haven't gone through many ETFs, and maybe there are better ETFs out there, but this is, or seems like, a high quality ETF. Okay, if you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.